Welcome back to our market update. Let's start with last night's key signals from Wall Street. The three major U.S. stock indices closed flat on July 16, but the futures market after hours showed some pressure. The Nasdaq ended at 25,881.95, the S&P 500 at 7,533.77, and the Dow Jones at 52,552.97, with no significant gains or losses. However, pre-market futures pointed to a pullback. Nasdaq futures were down 0.47%, S&P futures down 0.18%, and Dow futures down 0.16%. On the individual stock level, large-cap tech stocks showed divergence. Nvidia rose 0.7% and Tesla gained 0.62%, but Bitcoin-related assets came under pressure, with Bitcoin dropping 1.94%. There were no verified significant unusual moves in individual stocks, and the overall market was in a wait-and-see mode with shrinking volume. Now let's look at the global macro thermometer. Last night's signals were clearly conflicting but tilted toward risk aversion. The U.S. 10-year Treasury yield fell to 4.54%, down 0.61%. Bond prices rose and yields fell, indicating that money is flowing into safe haven assets. This usually reflects growing concerns about an economic slowdown or risk events, rather than a positive signal of liquidity easing. The VIX Volatility Index surged from 16.17 to 18.79, a gain of more than 12%, and briefly hit 19.34 during the session. It is now rapidly approaching the panic threshold of 25. Market sentiment has moved from normal to cautious, and the willingness to pull money out of risk assets is increasing. The U.S. dollar index was around 100.84, up just 0.07%, trading in a narrow range near 100.8. The weak dollar pattern has not been broken yet, but if the VIX continues to climb, the dollar could stage a rebound and put pressure on emerging markets. Crude oil bucked the trend, with WTI rising 2.55% to $80.93 per barrel. Gold edged down 0.28% to $3,975, still near its historic high. Under the combined effect of a slightly stronger dollar and falling Treasury yields, gold is oscillating at high levels without panic buying. The current market is clearly in risk-off mode. The core evidence chain is the VIX surge, falling Treasury yields, and tech futures pulling back, forming a complete risk aversion loop. This judgment would only be invalidated if Nasdaq futures recover from the 0.47% decline and turn positive, or if the VIX falls back below 17. Let's move to the external environment for Chinese assets. The renminbi exchange rate remained stable. Onshore U.S. dollar to Chinese yuan was at 6.7674, down 0.08%, while offshore USD/CNH was at 6.7805, up 0.09%. The onshore yuan strengthened slightly while the offshore yuan weakened a bit, but overall the range was narrow with no panic depreciation. This creates a relatively friendly external liquidity environment for A-shares. However, the global risk-off mood will suppress foreign capital's net inflows into emerging markets. So today we have a situation where the exchange rate constraint is small, but the sentiment constraint is large. On the news front, the U.S. Commerce Department's new rules on AI chip exports to China officially took effect on July 15, restricting sales of Nvidia's H200 and B200 chips to China. Meanwhile, the Netherlands and Japan have agreed to expand restrictions on semiconductor equipment exports to China, effective September 2026. These developments will certainly weigh on sentiment in the semiconductor sector. Add to that the fact that the People's Bank of China cut its loan prime rate by only 10 basis points, which was below market expectations, and the overnight VIX spike. With these three negative factors combined, we expect A-shares to open sharply lower today. This judgment would only change if the FTSE China A50 futures turn positive before the open, or if northbound capital turns to net inflows in the first 5 minutes of trading. For today's A-share market, the index direction is likely to be down, but with structural divergence. The Shanghai Composite and the Chi-Next board may extend yesterday's losses, but the decline could narrow. This judgment would be invalidated if the Shanghai Composite holds above 3,800 points with volume exceeding 1 trillion yuan. In terms of sector themes, we can focus on defensive sectors like utilities and power, as well as semiconductor import substitution driven by sentiment. The U.S. chip ban is a direct catalyst. Historical data shows that when sanctions are implemented, the sector often sees a short-term rebound. But this is more of a sentiment-driven trade, not a fundamental turnaround, so the upside is limited. If SMIC's A-share opens below 60 yuan, this logic breaks down. On the risk side, watch out for the export chain, including home appliances and machinery, as well as AI computing hardware like optical modules and servers. These are under pressure from tariff uncertainty and slowing global demand. Northbound capital is more likely to see net outflows today. Despite the stable renminbi, foreign capital tends to flow back into dollar assets in a global risk-off environment. Keep an eye on whether northbound capital outflows exceed 30 billion yuan in the first 30 minutes of trading. Here is the bottom line for today. Treasury yields are falling, the VIX is rising, and tech restrictions are in place. For A-shares, risk aversion comes first, but beaten-down import substitution names can be traded short-term. Our probability assessment for today is 10% for a rally, 25% for a sideways move, and 65% for a decline. Stay cautious out there.